Okay, we are now streaming live on Facebook and people are coming into the room on Zoom. I think we're ready to start. Kia ora, ngā mihi nui kia koutou. No mai haere mai ki te hui mariko, the online, welcome to the online seminar. Tonight, we're talking about impact investing. So this is the first in a series of 4 seminars that we're doing on impact investing. It comes as the 4th series in the last 27 weeks. Pretty much since the beginning of lockdown, when we decided we couldn't have face-to-face meetings anymore. So please visit our website to go and have a look at our previous seminars, and we'll put the website address in the chat for people to see. Welcome the audience joining on Zoom. It's great to have you, and the video, of course, will be available after this seminar for anyone to watch on various social media platforms and Mindful Money's website and on YouTube. So we're talking impact investing. As many of you know, it's a rapidly expanding area of investment worldwide. It's interest and enthusiasm about the potential for impact investing to not only earn a financial return, but also to deliver a social, positive, and environmental return. Tonight, we're going to talk with our panel about laying the foundations for impact investing. We're going to cover what impact investing is and how it's different from ethical or responsible investing. We're going to talk a bit about the international context. We're going to talk about why it offers potential for New Zealand in particular, and how different forms of impact investing are delivering solutions. I'm really pleased to welcome a fantastic panel. Really pleased to see you guys here, despite me giving you the wrong Zoom address. Firstly, let me welcome David Woods. David's Deputy Chair of New Zealand Green Investment Finance, the government's climate finance facility. He's also Deputy Chair of New Zealand National Advisory Board for Impact Investing. And he's Director of the Te Puna Hapori Fund. So warm welcome, David.
Thank you, Barry.
Rangimarie price, whakapapas to Whakatohea, Ngai Torere, Tuwharetoa, and Te Haunui Paparangi. She's also Director of the Connective, and we have others from the Connective along here tonight. She's Chair of Taitokerau Education Trust and former CEO of Amokura iwi Consortium. Warm welcome, Rangimarie.
Kia ora everyone.
And we have Jamie Newth. Jamie's lecturer at University of Auckland, CEO of Soul Capital, Chair of Ember Innovations, and a board member of the New Zealand National Advisory Board for Impact Investing. Warm welcome to you also, Jamie.
Thanks, Barry. Kia ora, everyone.
Cool. So let's kick off. David drew the short straw and is going to talk to us a little bit about demystifying definitions and what impact investing is, and maybe give us a snapshot of what's happening internationally. So over to you, David.
Thank you, Barry. And just before I start, perhaps I could add that Rangimarie is also a member of the National Advisory Board, so you've a slightly loaded panel here tonight where all 3 of us are members of the New Zealand National Advisory Board for Impact Investing. The term impact investing, as it's generally viewed today, is credited with having started with the G7 task force during David Cameron's prime ministership in Britain in 2013 and became the global steering group for impact investing about 2 years later. The idea was to promote more responsible investing, but to invest with intentional impact and with measurable results. And that's how the movement has started to grow. Some people also say that the investment has to be incremental as well as intentional. Now, New Zealand is a small market, but we recognized fairly early on that there were some really interesting opportunities here, and that the type of patient long-term investment that we saw as necessary and that the impact investing world seemed to be adopting is very similar to what Maori investors have been doing for generations. So it suited our market and the way things worked here. Impact investing tends to be driven by philanthropists, particularly in the US, and that has been the case here as well, with people like the Tyndall Foundation being extremely supportive of the sector. In the US, if you look at all the impact investing that has been done over the last 2 years, over 80% of it is in the housing sector. I think that what has been found in many European markets and now increasingly in New Zealand is that there is a role for government to play. In many cases, government can't really afford on its own to spend the sort of money that needs to be spent on social or environmental programs, but they can afford to pay for outcomes if the private sector finances the initial investment. So the famous example that is almost always used as the first example of this was in the UK, where a bond was launched to finance programs for prisoners coming out of jail. It's known as the Peterborough Prison Bond. And those programs were to help these prisoners and help them to not reoffend. The recidivism rate was only 9% in the prisoners that were financed out of that bond, and therefore, after 5 years, the investors received a 15% return on their original investment, because that was the link. The intention was to reduce recidivism. The measurement was the recidivism rate, and the result was a higher rate of return the lower the recidivism rate was. So that's how the market originated. I said it has been pushed in many markets by philanthropists. In Europe, it's also been pushed very hard by the younger generation. It's a little bit different from New Zealand. In Europe, the younger generation, my children, are growing up as the first generation since World War II to have a lower standard of living than their parents, and they're not very happy about it. So when they have some money saved, they tend to say, you, as our parents, as adults, have messed up our world. We want to save money. We want to improve the world. So if we put money with a bank or with an investment manager, we want to see that you're going to do something for society or for the environment, not just give us a financial return. And that movement has grown. You've seen it here. We've seen it. We've all seen it here in things like climate action. But that's how impact investing is starting to manifest itself, with a push from the bottom up and with a big helping hand from the philanthropic sector to say to the governments around the world, we can all do this together. We can invest responsibly, and we can generate both financial returns and social and environmental returns. When Sir Ronnie Cohen started the Global Steering Group for Impact Investing, he hoped it would have worked itself out of a job by 2020. We're not quite there now, but we're gradually getting to a point where all investment is purposeful. And if we look at how much has been done in New Zealand in the last 3 or 4 years, it's a real tribute to the efforts of New Zealanders and some of the funds that have grown up and responded to the demand from people, both in social impact, lots of very small deals, and in environmental impact, where we tend to have fewer but bigger deals. I'll stop there. And
well, thank you very much, David. Let's carry on the conversation, Rangimarie, by referring to sort of some of the ground truthing of this. And a lot of your work in Taitokerau has been on grassroots work on really where investment can be seen to be generating positive impact. Can you give us your perspective on sort of where impact investing is in New Zealand and where we can go with it.
Certainly, thank you, Barry. So with Taitokerau iwi, impact investment became really a solution to a problem that we were having. And that was really around the understanding that we had that the Taitokerau Māori economy is a developing economy within a developed economy. And in order for us to actually get some uplift and to realise the potential that sat inside our Māori communities, we needed to have more intelligent investment conversations, and we just weren't able to have that. So we were fortunate enough to meet up with Sir Stephen and the Tyndall Foundation and John McCarthy, and started a collaboration around, being introduced to the notion of impact investing. One of the things I do want to say is that really there was no intention for iwi to get into impact investing, but impact investing was, I guess, a close proxy for the way that Māori do investment and make investment decisions. If I could explain it this way, we take a systems level approach, or we might call it a whakapapa approach, where we understand that everything is interconnected. So we use some intelligent design to ensure that that we bring together sets of investments deliberately composed and governed in a way to unlock a combination of impacts. And we deploy that with a sort of a broader systems approach to the sorts of interventions we might take. We weren't able to have conversations with agencies or entities that were investing into things such as reducing destruction to the planet and reducing inequities and basically growing the Māori economy. So we were able, through our collaboration with the Tyndall Foundation, to develop and establish Te Pairotika o Te Taitokerau, which is Aotearoa's first Tikamalid impact investment platform, which is designed and owned and led by iwi and Taitokerau collectively. I left the role of CEO for that organisation in May, and it's since been taken up by Jodie Kere Tabua. But it was a way of applying the way that Māori viewed and looked at the world and their values to identify what good looks like for them, and including the measures that would give an indication as to whether or not we're travelling along the pathway properly towards that. So we take a longer term view of it. We work to intergenerational horizons. So what we found is most sustainable finance initiatives and investment failed to address these sort of the whole of system issues that create a particular situation to evolve. And so they are kind of geared to incrementalism, where we actually need transformation. So what we see is that capital can be part of the solution if we find ways of deploying it more intelligently. And I guess that's the approach that we've taken by actually using a tikanga-led investment approach. And I think that's what Māori can actually bring to the sector. And we're certainly finding that the finance sector is moving closer towards a te ao Māori approach to investment, particularly if they're wanting to actually get a greater return. And have their capital more future-proofed and not leaving the kind of footprints of destruction that they're currently leaving. What we also wanted to move away is from, I guess, the mindsets that sort of drive a really narrow definition of how value is, I guess, defined. And it's usually only value that is measured. We measure the things that we can count rather than measure the things that count. And so this was a way of actually demonstrating, I guess, just what the kind of impacts that and returns on investment that investors can get if they actually invested in a far more at a far more systems, at a systemic level. So I'll leave that there. I've taken up enough oxygen, and I'll allow you to move on to Jamie.
You've given more oxygen than you've taken, thanks, Rangimarie. No, it's really, really interesting. And I recall that you said that from a Te Ao Māori perspective, it's not impact investing, it's just investing.
Yes.
And so it's that thing about if the intentionality and the holistic framework is there, then actually you can spend a lot of time counting things and measuring things. But as you say, that doesn't supplant for the right holistic framework to start off with.
Absolutely. And I think, if we were looking to be more commercial, that if you're actually able to generate far greater returns and impact for your investment, then, why would you not look for that? So it's about intelligent design.
Cool. Thank you. So Jamie, we're hearing about some impact investment as payment for social outcomes from government. We're hearing it as a tikanga Māori sort of financing initiative. As an academic, your job is to unpick the categorizations and give us a way to understand the different flavors and types of impact investing, and in a way, where does New Zealand's impact sector go to? How does it develop?
Yeah, thanks, Barry. And before I get into that, I just want to build on what Rangimarie has said. And that is, when I look at what's happening in New Zealand and how we can advance things, and potentially we all kind of lament other geographies being more advanced, and we would advocate for more government-led market-making activities like the creation of a wholesale fund and that kind of thing. And so we say, well, we really need to catch up. In many respects, the rest of the world needs to catch up to us, and that's exactly what Rangimarie was saying. And we've got a unique opportunity in New Zealand with increasingly as iwi and other Māori authorities hold and manage more assets and have retained the deployment and the thinking about the management of those assets, have retained purpose being central to that. That gives us a unique cultural platform to take back to the world in terms of how impact investing can be done. And so, yeah, we need to catch up policy-wise in terms of amount of capital and that kind of thing. But in many respects, we've got a great opportunity to build off what the Māori economy is already doing and leading the way. And that's really exciting. So when we talk about impact investing, and every industry body will have a spectrum of some kind. Yeah, and I think you've probably been working along the spectrum with your seminar series, Barry. We move from traditional investment along, ESG integration to negative screening, positive screening, so on and so on. And now we're getting down to the exciting stuff with impact investing. And so we think, well, okay, it's a category, right? And people think because you've got, a focus on financial returns at one end of the spectrum and increasing focus on a different other forms of value as well, that naturally means that financial returns must be decreasing as you move along that spectrum, which we know not to be the case, right? We know that ESG and sustainable investing is generally outperforming, and I think there's adequate evidence to say that we can say that confidently. So why should it be any different for impact investing? Just because we are looking to contribute and to fund the solutions to social and environmental problems doesn't necessarily mean that the financial returns are lower. And so when you actually open that box of impact investing and see what's in there, there's tremendous diversity, not just in terms of asset types and types of instrument as you're referring to, Barry, but in terms of the risk return profiles that are in there. And so we can invest for impact and achieve market rate returns, but this is a choice, and it depends on what impact you're looking to have, what problems you're looking to solve. Some of those have a big, grand challenges with big markets behind them. And therefore, particularly when we're funding innovative solutions, especially when there's technology behind it, the returns from investing in those vehicles can be as strong as anywhere else, naturally. But it's a choice, and there are when we're investing to solve solutions, we're using a market mechanism, we're investing in a place where the market is not working. So naturally there's challenges in there, increased transaction costs, returns may be lower and that kind of thing. And so we can say simply, well, there's finance first impact investing and impact first impact investing, but there's a whole lot in between as well. And there's multiple different flavors of what we're trying to achieve, depending on what your purpose is. And so, yes, you can get market rate returns, but you can quite sensibly and intentionally and powerfully seek sub-market returns because of the nature of what you're investing in. And then so that's just on risk and return kind of profiles, but in terms of there's nothing about impact investing that precludes pretty much any asset type or instrument necessarily, although some are more natural fits than others. It's about the purpose behind the investment and what you're trying to achieve with it. And so the good thing about everything I just said is that it's not weird. It's got the legitimacy that I think we need as investors and as fund managers and as policymakers to say, here's a legitimate tool to addressing social and environmental issues that are enduring and are potentially wicked or intractable. And we're increasingly building the evidence base that says these things are investable, and that they work, and that we can measure the impact, and that there should be as far, not only should we, escalate our movement of assets under management in our economy to having more impact and purpose behind it, but that as advocates of policy and government intervention, there's a lot that can be done in terms of helping to make that market. And then we can go through the different types of investors and asset owners and say, what's the case for them getting involved? And there's pretty strong cases. So it's built, legitimacy has been built, the case has been made, and I think it's time for us to escalate.
Yeah. And I guess your point about asset classes is some lend themselves to an early entry into the impact investing field. So, for example, when Responsible Investment Association did their figures on how big the impact investment world is in New Zealand, they got to a figure of $4.7 billion, but almost all of that is forms of green bonds or climate bonds. David, you see it from your role on Green Finance Limited. Are you seeing the kind of investable opportunities around emissions reductions, or I know that Green Finance is taking a little while to build your portfolio. So, how's the kind of investability of what you're seeing in terms of opportunities?
I think we've seen a large number of opportunities. I think there was a sort of a sense at first that we were caught between not being big enough in terms of capital to do credit enhancements on green bonds. If you launch a 500 million green bond, our 100 million of capital used as a credit enhancement would use a lot of our capital in one single transaction. But we're also not set up to do lots and lots of $500,000 transactions. So finding transactions in that $5 to $15 million sweet spot wasn't particularly easy. And simply explaining the different parts of our mission, that we were there to transition to a lower emissions economy or directly reduce emissions in a project, but also we were expected to crowd in private sector finance. So if we came into the deal, we would bring private sector finance in as well. The first deal we did was a loan to Centreport, and when we looked at that deal, people said, well, how are you crowding in private finance? We were crowding in private finance because we were able to give Centreport the money now, where the banks wouldn't give it to them for another 2 years. So we were able to accelerate the emissions reduction through taking that role on. So we've seen a steady flow, but I think we would all of us who are involved would say it has been slower to get things moving than we expected. And there are many transactions around in the market. I saw a question come up on the chat about returns versus impact. In impact investing, it's not just risk and return, it's risk, return, and impact. And you can't have a high impact and a high financial return without taking a high risk. And that's sometimes where these transactions become quite difficult. People think that they can have high return and high impact, but not have to take high risk and return.
Yeah, so it becomes a three-dimensional matrix as opposed to a two-dimensional. Yeah. So thanks for those who are posing questions. We'll gradually get to these as the seminar goes on. For those on Facebook Live, please post your questions into the comments section. And I've got a colleague there, Toby, who'll pass those questions through to us here on the Zoom chat. So Rangimarie, back to your point about, I think the saying is, not everything that counts can be measured, and not everything that can be measured counts. So I thought it was a really good point of yours that you can get really tied up in measuring stuff without actually it adding any value to. And we've had a question come in from somebody who you know well, from Ian. Hi, Ian. Is the cost of impact investment held back by the cost of measuring the things that matter? And particularly, he suggests on social returns. So do you see that from your experience that you know, if you really want to satisfy the appetite of financiers for nailing all the measurements down, you're going to end up with things that don't suit the scale and don't suit the style of what it is you need to do, and don't also suit the participative methodologies that you want to use.
Absolutely, and I think that's part of the reason why we decided to create the impact investment platform that we did, because what it meant is that so there was a project development company so that would enable us to actually bring through some of this pipeline of deals and get them investment ready. And then on the other side of it, have an investment structure that would be, I guess, aligned to what we were bringing through. And the reason why we did that is that that people were coming to our table on our terms. Which meant that you weren't necessarily getting tied up with huge transaction costs around trying to, I guess, appease investor expectations around the various permutations of what social good might look like, because we would have defined that for them as part of the investment conversation that we were having with them. So it was a way, I guess, of ensuring that engagement with our people was on our terms, and it's mana enhancing, because what our experience has been is that there is an imbalance in those conversations when you're at the point of need in a marginalized community and you are engaging with a finance sector that has huge power.
Yeah.
And behave accordingly sometimes when they're quite transactional in the way that they, I guess, are trying to make a return off the back of that need. Now, we don't see a problem with the fact that people are entitled to actually get a return for actually investing into the things that matter to us. But what we wanted to do is to actually dictate what the terms of that might be like and what the behaviors would be. And so it's kind of I guess, a different way of having conversations, intelligent conversations about investment opportunities that sit inside our communities. So it wouldn't necessarily also just be the financial institutions. This was also government investment that was coming into the region. And at the time, and still is, they were actually investing without necessarily expecting any return on that investment. And so this was a way of actually, well, you could perhaps get better outcomes if you invested this way. You know, so it was, I think it's coming from a position of power rather than from a lens of deficit in terms of what the opportunities might look like.
It's really healthy, eh? In a way, the changing of the power imbalance between those who have money and those who are going to use it.
Yes.
And how do you maintain that power balance so that essentially you don't get dictated to? Is it because in a way you've got some choice about funding mechanisms, or is it that you're prepared just to wait until the conditions are right and the terms are right?
Yeah, because I mean, if people were genuinely interested in, say, investing into something that's transformational and turns the dial around communities that are marginalized and enabling them to actually develop, then the way that we would control those conversations is that we would be saying that the tikanga, it's based on our tikanga. So we would be ensuring that we're actually values aligned first. Right, and so what that means is that the approach and the behavior, because impact investment and being, I guess, more broader in your expectations around how this could happen is actually about a change of behaviours. And this, at its very core, is around behaviours with money, and how you handle that, and the agency you take as a result of you maybe sitting at the more stronger end of the continuum because you sit on the money and you have high need at this end. So it was definitely, if we're values aligned, then we have a conversation to be, and if we're not, there's no conversation to be had. Yeah,
it's really interesting that values alignment is particularly the case, of course, for the philanthropic sector. So I guess it's not surprising that they would be early adopters. Jamie, on that, I was kind of struck by the example of community finance and the Salvation Army putting together a social housing finance package that also was able to leverage in KiwiSaver funds through Generate. That's something we'll delve into in a future program. But it sort of comes back to your point about the different flavors of impact investing and how it will evolve in different ways in different asset classes and situations.
Yeah, and if you are signing up to be an impact investor because you're a trust, a foundation, or a KiwiSaver fund, then you need to line up the asset type and the instrument with the type of impact and to what David's point, the risk level of risk return and impact that you're seeking to achieve. And so things like real assets, like housing, is the type of asset where you will get interesting bedfellows in really powerful ways, where you can get solid risk-adjusted returns from a KiwiSaver fund that also get to tell a good story about the kinds of things that they're investing in and to build a competitive advantage that way, alongside trusts and foundations for whom housing is a priority and it's part of their mission. So that's not surprising, but there is I think there's a lesson in that as mainstream investment managers come into the impact investing space, is that care needs to be taken to make sure we're using the right instrument in the right way to achieve the right impact, and then have the right measurement disciplines wrapped around that. And the point that I like to make about measurement is that it is fundamental to impact investing, right? It's a key principle of impact investing, a dimension of the definition even, but it's not just from a compliance reporting kind of perspective. It's so that you can manage your impact better, so you can make better decisions and have more impact. And yes, engage your stakeholders and all that kind of thing, but it's not just a compliance reporting function, it's a strategic function as well, because your intent is to make change. So yeah, the point I was making before, that for different types of investors, impact investing makes sense for different reasons. And so your pension funds, so your KiwiSavers, etc., can provide more compelling investment opportunities that provide solid returns, but they can make the case in how they're contributing to the solution to social and environmental problems, whereas your regional and community trusts and family foundations even can leverage greater assets for their kaupapa, right? Not just the returns on their investment capital, but their investment capital as well. Yeah. And then they can get really exciting because you can blend finance in really, really powerful ways, whether that's with having an impact fund with a sidecar grants vehicle, taking first loss positions to crowd in other investors for whom the risk doesn't quite stack up, and so you're catalyzing mainstream investors. You're catalyzing the machinery of the private sector to your mission, and we're early days in that kind of stuff in New Zealand, but that can be particularly powerful.
I wanted to pick up on that sort of sidecar of grants attached to impact investing, because I mean, Mark Ingram's asked, thanks Mark, can blended finance overcome market friction to solve some of the problems? And David, I'm kind of aware of your experience also on the Impact Enterprise Fund, which has looked at an enormous number of deals in order to sort of whittle them down to those investable ones. It's a different approach than philanthropic funding, where you can have that blended finance.
Philanthropy can play a role in blended finance. I mean, John Goldberg also asked a few minutes ago about impact investing in developing markets, and that's in many ways where impact investing was seen more often, and typically it was a blended approach of a public sector institution, often a development finance institution, a private sector institution, and philanthropy. And philanthropy was providing some sort of grant aid in those structures, whether it was for training people or for certain parts of the intervention. But that's how it grew up. If you look, you mentioned Mark Ingram a minute ago, if you look at Christian Super, which is Brightlight's parent, Christian Super has one of the best developed spectrums of investment across the board, and they have a sector that goes into impact investing. And it's primarily, or was primarily, in the developing markets because they could manage the risk return impact triangulation very well. So I think if you look at all of that, you know, the question Craig Fisher asked about mainstreaming that you were talking about just now, in New Zealand, to get mainstreaming of impact investment, we need the measurement science to be better. Because if you're asking mainstream investors to look at illiquid and unlisted instruments, they have to have something that's pretty scientific and objective. They can't take warm and fuzzy. And so that's the direction that I think things are going. You cited the Generate KiwiSaver investment in the housing transaction, which was terrific to see. But they're going in there because there's some hard measurement that's there to support that investment. And I think that's what we need to see. And we also need to see support for developing ways and people who can provide measurement, so that we're not just dependent on the big four coming along and saying, we'll measure the impact and please write us a check for $100,000, because in that case, measurement's not going to work. To Ian's point of, is measurement too expensive? Yeah.
So that really does talk about the shape of the sector going forward, that there will be a mainstreaming component, but particularly maybe for asset-backed securities such as social housing, and those for which there is significant amount of financial data and track record, versus things a little bit more at the community level where a different kind of investing takes place. Is that the kind of model that it looks like we would move towards, more of a philanthropy-led, grassroots-oriented impact investing sector, which might be quite separate from the larger scale of the more mainstream deals? What do you think, Jamie?
Well, I think those kinds of organizations, your trusts and your philanthropics, are likely going to need to lead the way into getting impact investment capital into places where, and in ways where the market isn't. because the market won't. And that will mean, to your point, that they will need to take intentionally create funds or take a strategy where they're taking lower financial returns, or like I was saying before, taking a different position, a catalytic position, so first loss capital, etc., to bring other investors into deals. And that is likely to be with instruments that are particular to, let's call it grassroots, or where mainstream capital isn't getting. And that's not just in terms of social enterprise and community housing and agriculture and that kind of thing. I think it is going to be even your more investable tech startup kind of opportunities in the wrong place, disconnected from mainstream markets, are going to need to have targeted kind of support. But I think investors of different kinds will find impact opportunities that fit with what they're looking for. But I think you're right. You will see your philanthropics playing in a certain way and hopefully being catalytic. And you could argue that there's a role for government in that. And then your VCs and private equity investors will see investable, scalable opportunities, often with technology, which are really taking a social environmental problem head on, but with a scalable, investable model. And so they'll use the usual instruments, have the usual kind of mindsets. And then what needs to come along with that is, how do we maintain integrity given the ethos and what we're looking for with VC and PE investments? We can find founders, scalable business models, big markets, cool. How do we maintain the integrity of the impact of that from an early stage when the vehicle doesn't have a lot of capacity for measurement? But how do you maintain that as it scales? Because that's where measurement is required to maintain integrity.
Yeah.
Because otherwise we can all start doing what we call impact investing and not necessarily deliver on the promise of it.
Rangimarie, do you see this as gaining traction across different iwi and different Māori communities? Is this approach to investment going to be transformative? Are you kind of seeing some larger scale applications starting to occur?
Yeah, like I was saying, that I guess if we're talking about a Te Ao Māori approach to investing, it's actually usually far more advanced than how impact investing currently is. So if I was to be brutally frank about it, I think having the label of impact investing actually has a reductive effect on Māori approaches to investing. So I think the fact that the work that was done in Te Taitokerau to actually formally set up a platform like that, I think that's there might be some power in that, in the sense that if this is the direction that the mainstream might be moving to, because that's what the market requires, then I think that can only be a positive, because what they will be looking to do is to be far more responsible in terms of how they deploy their capital and the kind of good they want to see as a result of it, and moving away from shareholder primacy to stakeholder primacy. Because I think, the trajectory is that we're going to lose a license, I think, to continue to deploy capital in a way that destroys the planet and creates unjust or inequity in many places in society. So I think that the license to be able to do that, I think the market might actually say they have less appetite for it over time.
What a really good place to end the seminar on. I'm sorry, we're going to have to sort of cut it short. We kind of advertise these as short, sharp seminars, and we could continue this discussion for a very long time. But thank you very much. I think that last point, Rangimarie, is so important, that you look at initiatives like the Sustainable Finance Forum, and that is very much around what's that license to operate for the financial system as it is, versus a kind of more responsive system to society's needs and, in a way, their permissions. So changes coming, and that's going to be really welcome. On the series and in the next few seminars, we're going to be talking about specific funds next week, and we're also going to be talking about emerging markets and developing countries. And we'll take a closer look at the social housing case, and then we'll come back to some of the more structural and policy issues around impact investing, some of the things that Jamie raised around policy and regulatory issues. But thank you all very much. Thank you very much to Rangimarie. That was fantastic, and thank you, David, for what you've done in this area and the kind of leading role you've played. And thank you very much, Jamie, for the academic rigor you always bring to this. So thanks to all of you who are listening to this. Please check in next Wednesday, 7 o'clock for next instalment. And we'll run these through the rest of October. Again, the information on past seminars and this recordings will be on Mindful Money's website, www.mindfulmoney. We're very much about moving the spectrum of understanding from where people are at the moment, which is for much of the public not knowing where their KiwiSaver funds go, through the negative screening, the positive engagement of funds in improving companies, ESG management, and in towards impact investing. So that's a kind of educative process that we hope these seminars will contribute to. Thanks again all, and ka kite anō.
Thank you.